Welcome, everyone, to this executive briefing. If you've spent literally any time tracking global markets, you already know that macro trading can feel like trying to solve a puzzle while someone else keeps moving the pieces. It's notoriously chaotic. But today, we're bringing absolute clarity to that chaos. In this explainer, we're going to outline exactly what the data is signaling for our near-term positioning by breaking down the core methodology of the Isochron report. If you want to understand how the underlying gears of the market actually turn, and more importantly, how to apply them to today's tape, you are absolutely in the right place. Let's get started.
Okay, let's dive into this foundational statement right off the bat. The Isochron report defines its mission perfectly with this quote: "An authoritative, systematic macro report mapping the structural convergence of global liquidity flows, geometric time cycles, and intermarket price analogs within the ES book." Now, I know that single sentence is incredibly dense, but it's the absolute bedrock of what we're covering today. We aren't looking at opinions or discretionary hunches here. We're looking at a highly authoritative, systematic map of market realities.
To deconstruct this methodology for you, our agenda is going to cover the systematic framework, global liquidity flows, geometric time cycles, intermarket price analogs, and finally, the ES book convergence.
Section 1. The systematic framework. So this entire methodology is governed by a very strict rule of three. The report doesn't try to measure 100 different disconnected variables. Instead, it isolates exactly three core analytical pillars: global liquidity flows, geometric time cycles, and intermarket price analogs. This tight systematic approach means the analysis remains fiercely focused. By isolating just these three essential ingredients, it creates a structured lens through which the massive, often overwhelming complexities of global macro trading can be logically understood and strategically mapped out.
Moving right along to Section 2, global liquidity flows.
And this brilliantly illustrates the foundation of the market's underlying plumbing. Think of global liquidity flows as the first systemic macro factor. The report maps these flows because, well, liquidity is essentially the fuel that drives the broader market engine. Right now, we're seeing exactly how specific injections and drains in this global liquidity are disproportionately driving shifts across distinct asset classes. Current data points show capital rotating rapidly, and that dictates whether institutional money is flowing into risk-on equities, defensive bonds, or commodities. It's the absolutely crucial first layer of analysis that sets the baseline environment for everything else that follows.
Section 3. Geometric time cycles.
Now, what's really interesting about this slide is how it frames time not as some passive background element, but as an active geometric factor. Geometric time cycles serve as the second systemic macro factor. This means we aren't just looking at what happens in the market, but the mathematical, structured timing of when it happens. And it's not just theory, folks. In the current environment, these geometric cycles are heavily influencing our immediate price patterns. They help us pinpoint the exact windows where momentum is statistically likely to either accelerate or completely exhaust. It's a highly structural way of analyzing duration to actually time our tactical entries.
Section 4. Intermarket price analogs.
This third systemic factor, it's all about deep pattern recognition. Intermarket price analogs involve mapping comparative price relationships across different markets. It's about understanding that absolutely no asset trades in a vacuum. By analyzing how prices interact and basically mirror each other across interconnected global markets, the report identifies structural analogs. These are historical or cross-asset patterns that give us a much clearer picture of current price action. It's the critical third dimension, adding that relational price context to the fuel of liquidity and the rhythm of time we just talked about.
Section 5. Bringing it all together with the ES book convergence. Let's move to and see how this builds into the core thesis of the report. Look, on the isolated factor side, looking at liquidity, time, or price alone can definitely give you some clues, but it's fundamentally an incomplete picture. The true power of this methodology is structural convergence, mapping the precise intersection of all three pillars at once. When liquidity, time, and price perfectly align, we get a highly actionable signal. Based on the current convergence of these exact three factors, the tactical expectation is a sharp, directional breakout rather than continued range-bound chop. Why? Specifically because cyclical timing windows are closing exactly as fresh liquidity is hitting key resistance analogs.
So the crucial point is exactly where this convergence is being mapped, right within the ES book. Because all these global forces meet directly in the S&P 500 futures book, we can project near-term volatility with incredible precision. Currently, this structural map outlines two very contrasting risk scenarios for us to watch. On the upside, the scenario relies on a confirmed liquidity breakout that sustains above structural resistance. That's what triggers algorithmic trend-following buying. Conversely, the downside risk scenario gets triggered if our current geometric time window expires without that liquidity follow-through, which would lead to an immediate, sharp mean reversion sell-off.
So what does this map reveal about the ES book's next reality? Well, it tells us that based on the immediate convergence of current liquidity flows, geometric time cycles, and intermarket analogs, we are stepping into a critical and highly volatile window. By applying this systematic, structural lens, you aren't just guessing at the market's next move, you are systematically mapped for it. Thank you so much for joining this Executive Explainer. I highly encourage you to keep these two risk scenarios front and center as we navigate the coming sessions.